Cost allocation within multinational groups is a critical task to ensure compliance with transfer pricing regulations and fair treatment of group entities. This process involves identifying costs incurred by headquarters, HQ, for the benefit of its subsidiaries, distinguishing these from shareholder costs, and applying appropriate methodologies for allocation. The goal is to achieve transparency and compliance, while maintaining an equitable distribution of shared expenses among group entities. The first step in allocating management costs is identifying which headquarters costs benefit the subsidiaries. Headquarters often incurs expenses that support the operations of the group, such as IT infrastructure, HR management, legal counsel, financial advisory, and strategic planning. These costs must be carefully reviewed to ensure they are properly categorized. Only those expenses that directly or indirectly contribute to the activities or value of the subsidiaries should be considered for allocation. This initial classification is essential because it creates the foundation for determining which costs should be shared among group entities and which should remain at the HQ level. Once the relevant costs are identified, it is essential to eliminate shareholder costs, which may not be passed on to the subsidiaries. Shareholder costs are expenses incurred by the parent company in fulfilling its legal and administrative responsibilities as the central governing entity of the group. These costs typically include maintaining the legal structure of the parent company, meeting the financial reporting obligations of the parent, and managing capital-raising activities for the acquisition of subsidiaries. Such expenses are generally not tied to the operational activities of the subsidiaries and do not provide direct or indirect benefits to them. As a result, they must be excluded from intercompany charges to ensure compliance with the arm's-length principle. Allocating shareholder costs to subsidiaries can lead to disputes with tax authorities and challenges in defending the transfer pricing methodology during audits. After removing shareholder costs, the next step involves determining an appropriate cost allocation key for the services provided by HQ employees. Employee-related costs often represent a significant portion of HQ expenses, and their allocation must reflect the nature and purpose of the services rendered. For example, when employees provide direct services to specific subsidiaries, such as negotiating a local contract or managing a subsidiary-specific project, the related costs should be charged directly to that entity. On the other hand, for shared services that benefit multiple subsidiaries, such as financial planning or global supply chain management, a fair allocation key must be applied. Suitable allocation methods may include time spent by employees on each subsidiary or revenue generated by the subsidiaries receiving the benefit of the services. A clear and transparent methodology not only ensures fairness, but also reduces the risk of disputes during tax audits. In addition to employee-related costs, HQ often incurs other direct costs that can be easily traced to specific subsidiaries. These expenses include legal fees associated with subsidiary-specific litigation, marketing campaigns targeting particular markets, or training programs for employees from individual subsidiaries. Allocating these costs directly to the relevant group entities is both straightforward and compliant with the arm's-length principle. Direct allocations eliminate the need for broader allocation methodologies and make the allocation process more transparent. Accurate record-keeping and documentation of these expenses further support compliance efforts and enhance the defensibility of the allocation during regulatory reviews. For remaining indirect costs, which typically include overhead expenses such as IT systems, HR support, and facility management, an arm's-length allocation key must be used. Indirect costs often benefit multiple subsidiaries without being directly attributable to any specific entity, requiring a logical and defensible approach to their distribution. For instance, IT costs may be allocated based on the number of software licenses used by each subsidiary, while HR costs could be allocated based on the headcount or payroll size of each entity. Similarly, facilities costs might be distributed based on the office space occupied by each subsidiary. The choice of allocation key must align with the actual usage or benefit derived by the subsidiaries, ensuring that the methodology is both fair and compliant with transfer pricing rules. Transparent and consistent application of these keys is vital to maintain regulatory compliance and prevent disputes with tax authorities. An additional consideration in the allocation process is the determination of reimbursement costs that can be charged to subsidiaries without a markup. Certain services provided by HQ may qualify as low-value-adding services under the guidelines established by the Organization for Economic Cooperation and Development, OECD. These include routine activities such as payroll processing, basic IT support, or procurement coordination, which do not form part of the group's core business activities. For such services, the OECD allows for a simplified approach, where costs may be charged to subsidiaries without a markup, provided the allocation methodology is transparent and the services meet specific criteria. This approach reduces administrative complexity and ensures compliance for routine intercompany transactions. However, the no markup rule applies only to services that meet the OECD's definition of low value adding and is not applicable to core business services or strategic management activities. In conclusion, allocating management costs to subsidiaries is a complex but essential process for multinational groups. By identifying costs incurred for the benefit of subsidiaries, eliminating shareholder expenses, applying appropriate allocation keys, and adhering to the arm's-length principle, groups can achieve a fair and compliant distribution of shared costs. Proper documentation and consistent application of allocation methodologies play a critical role in ensuring the defensibility of the allocation process during regulatory scrutiny. With careful planning and execution, cost allocation supports the operational and strategic goals of the group while minimizing the risk of disputes with tax authorities.